All right, so you've been investing in dividend stocks or testing the waters with various small cap positions and companies in your portfolio, right? But as the economy progresses and we get older, you start to think about stability. You start to think about growth. You start to think about the future over the long term, along with your retirement years, right? And at least you should be considering, at the very least, you should be considering retirement, right? And consequently, when you think about future investments, by proxy, you also consider what you need to invest in order to achieve or obtain that growth in your investing career. That growth is the singular purpose of SCHG, except with this particular ETF, there is a heavy emphasis on the tech sector. Listen, there's an ETF, all right, for everything that you want in the stock market. You just got to find it. If you're the type of person that gets anxiety from selecting singular stocks, there's literally a reason you never have to do that, okay? You never have to research singular stocks unless you want to. But listen, there is a basket of stocks for nearly every sector you want to dial in on. Now, when you say SCHG swiftly, it sounds like SCHD, but understand that these two ETFs are very different. Both are passively managed. Both have been around for about the same length of time, with only a 2-year difference, with SCHD being launched back in 2011 and SCHG being launched back in 2009. Because they are both passively managed and not actively managed, okay, that means that their performances are determined by the underlying assets within the ETF, or in other words, the individual stocks and companies that have been selected to go inside of these ETFs. We are essentially talking about a set it and forget it type of deal. However, their performance over the years will help to show you the main difference between the two. Right off the bat, I'm going to tell you right now, SCHG destroys SCHD on just about every chart in the lineup, okay? It doesn't matter how you line it up. 1 year, 3 year, 10 year, doesn't matter. SCHG is heads and shoulders above SCHD, but it's supposed to be, okay? That's what it was designed to do. It's literally in the name of the ETF, right? It's focused on value and growth companies, maximizing your capital returns over dividends, which, speaking of which, SCHG does have a dividend. However, it's around 0.44% or something insignificant like that. But again, that's not the focus here. We have other ETFs and stocks for dividend income if that is what you're looking for. This here is for the growers. So what's inside of this thing? Well, let's take a look together and see what's all inside of SCHG and why it is so heavily focused in the tech sector. Ladies and gentlemen, this is a tech-focused ETF once again. So if you're looking for something that encompasses the growing tech market, I know we just recently saw the huge boom that the tech industry got over the past, 6 months with NVIDIA and Apple and Microsoft. Those IPOs shot through the roof, literally, okay? But I'm going to show you what's inside of this ETF, and then you can make a conscious decision on whether or not SCHG is for you. Let's get into it, all right? So you see here, Schwab U.S. Large Cap Growth ETF SCHG. Again, that is the Schwab U.S. Large Cap Growth ETF. This is specifically tailored towards stocks that are poised and positioned to be huge growers within the next 5 to 10 to 15, 20 years, okay? So again, this is not an ETF. If you are looking for something to basically get a large dividend return on. Again, as I said before, we have other ETFs for that, right? So let's get into the top 20, all right? I'm not going to go over all of the holdings, but we're going to go over quite a few of them and see what's all inside of this thing and what's going on. For starters, let's go to the actual SWAB page. So you'll see that this thing right now goes for about just under 90 bucks, okay? And I know for some people get caught up in the price, but again, guys, ladies, partial shares are a thing. Find you a broker that does partial shares. That way you can invest whatever you want, whenever you want, and you don't have to worry about buying a full share of anything, okay? There's Cash App, there's Robinhood, there's Webull, there's I think Moomoo. Listen, just about every brokerage you go to these days will offer some form of partial shares. So we don't have to worry about paying that full price. But again, this is just under 90 bucks, which is compared to a lot of other ETFs and a lot of other things like the VOO. Like if you wanted to go with the top 500 companies, VOO is very expensive, well over $400 right now. So again, just under 90 bucks. All right. And if you want to know how many, okay, this is large cap. So we're talking billions and billions of dollars here, billions of dollars here. All right. So if you want to know how many holdings they have, that's 250 total holdings as of 4/19/2024. So as of the 19th of this month, April, they have 250 holdings within this portfolio, within their portfolio. Again, this is passively managed, and you can really go to the to the SWAB website and get some further details for you that wants to know about the performance and how they've done over the years and the portfolio. You can go and click on all of that. All that information is right here for you. But what I want to do right now is focus on, I like to use stock analysis because I just like the interface a lot more. So starting off at number one, when we can look at the holdings that are on this list, Microsoft, okay, is at the top of the list along with Apple, okay. Microsoft is weighted at just over 12%, almost 13%, with over 8 million shares. Apple is next up with over 15 million shares. Right after that is Nvidia, okay? Right after that is Amazon. You got Meta coming in at number 5, number 6, Google, and number 7. You have Google, and then you have both IPOs. All right, so you have for the alphabet, and then you have Eli and Lilly Company. You have AVGO, which is Broadcom. You have United Health Group, which is one of the biggest United Health groups and providers here in the States that we have. There's over 1 million shares of that. That makes up almost 2%. At number 11, you have Visa. You have Tesla at number 12. 13, MasterCard. I love seeing Visa and MasterCard on this list. I put out a short video maybe a couple weeks ago, and it was talking about how I love investing in Visa because Visa is one of the companies that owns the most distributed credit card lender in the States, right? So that means that a whole bunch of Americans owe them a bunch of money, right? So why not invest in Visa directly and be a part of that dividend flow? Have them pay you out some money for a change instead of us always paying them through the use of credit card applications, right? So I have Visa. Visa has personally been added to my dividend portfolio, and we'll go over my dividend portfolio very, very shortly so we can see where that's at. But number 12, Tesla. Number 13, MasterCard. I love to see them on there as well. 14, Costco. We all know Costco. Y'all love Costco. I love Costco. 15, Salesforce. 16, Netflix. 17, AMD, another tech microchip. AMD is, listen, if y'all know about the chip industry, then you will know that AMD was one of the biggest movers for the chips go, and they have seen an incredible increase over the past couple of months, 6 months to a year. Number 18, we have Lind. 19, Adobe. 20, Thermo Fisher Scientific Inc. And I'm not, listen, I'll be the first to tell you that I'm not too familiar with TMO here, Thermo Fisher Scientific. I am familiar with number 21, which is Accenture. Very familiar with them. I love Accenture. But listen, you can go through the list. Again, 250 holdings that they have. Very, 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 very tech focused. If you go to the overview and you look at the last month, they're down 5%. But if you look at the last year, they're up 34%. My goodness. Up 34%. Ladies and gentlemen, all of that gain is coming from the tech boom that we have seen over the past couple of months, and it is fantastic. Up over 34% on the year chart. 5 years, up over 114%. Again, if you're looking for something, okay, to add to a portfolio, not necessarily your dividend portfolio, but you're thinking, let's say you're thinking about the future. You're thinking about 25, 30, 35 years from now. You want to invest in something now that's going to see some major gains and growth. This is an ETF, SCHG, that you need to check out. I want to go to the dividends because I do have a dividend. Okay. Annual dividend is 40 cents. I told you that. You can see it fluctuating here. The payout ratio is only 17%. Again, this is not about dividends. Okay. Though there is one there. I do want to switch back here so I can show you. The cost for this, because there is a cost associated. So there you'll see the total expense ratio being 0.04%. Okay, and that is not a lot of money at all. It's very cheap, and you'll notice that passively managed portfolios are going to be and tend to be cheaper, a little bit cheaper as far as the expense ratio goes, than actively managed portfolios, because again, an actively managed portfolio means that there needs to be a dedicated team watching that ETF, watching that portfolio daily to see what's dropping, what's lowering. Something may move out of that portfolio's requirements, right? So it has to be actively managed. But this is passively managed. So typically you'll see the expense ratio reflect that as well. So again, ladies and gentlemen, I give you SCHG. If you're looking for something that is tech focused, that is focused on growing companies that are looking to be 25 to 30 to 40% higher, worth more than what they are today. Companies with large moats, companies with a history of success, then I implore you to check out SCHG. You all let me know what you think in the comments. Again, this is going to be different from investing in something like VOO. Okay, VOO, top 500 companies. This only 250, and you'll see that the majority is focused on the tech. So the tech is doing good. Guess what? This thing is going to go crazy. Tech doing bad, you're going to see it reflect here. So those are your pros and your cons. You got to decide on your own which one you think is, if it's worth the risk. If you see tech being something that 25 years from now is leaps and bounds ahead of where it is, all these companies, Microsoft, Apple, Amazon, do you see those companies being worth way more than they are even today? Then you got your answer. right? So I implore you, go ahead, check this out. This has been Play of the Day. Keep this nice, short, and simple. Before I get out of here, let's look at the portfolio. My dividend portfolio, ladies and gentlemen, is sitting at $7,825. Again, that is where it's sitting today. I have zero buying power because every time I get a dividend, I actively go in and purchase something else with it, okay? And the thing about Public, okay, and this is not an ad for Public because they're not paying me to say this, but the thing about Public that I like, again, Public has a community of people, okay? And you can choose to engage or not with your different purchases or things that you've got your eye on as far as stocks go. And you can set it to where your dividends are automatically reinvested, or you can choose to receive that money, those dividends, and then you do with that money whatever you want to. Now, right now, as it stands right now, I have my dividends not being reinvested because I am tracking every purchase, every reinvestment. I am tracking it with the app, okay, with my dividend app that I have, so that I can correctly and accurately input that data into the app so that I'll know exactly where I am. And we're going to bring it up in a moment. But I'll show you at the top right there, you see ticker symbol O, that is Realty Income. And I am heavy, okay, I'm a big proponent of O. And honestly, I want to get that thing up to well over 100 shares, okay? But you see right now, that is where the majority, the bulk of my equity for this dividend portfolio lies. Okay. So it's 37%, over 37% of this portfolio, over $2,000, almost $3,000. Right behind that, you'll see SCHG. Behind that, you'll see SCHG, and so on and so forth. So these are all of the things that I have within this portfolio right now. And tomorrow, I may just add two more that we'll go over on Play of the Day. But I want to show y'all. I want to show you all what this portfolio at $7,000 is yielding me per month. Okay. Again, I'm using an app called the Dividend Tracker. It is free because I love free things. Why pay for something if you can get it for free, right? That is the only, by the way, that is the only downside to this particular tracker, okay, is that every purchase that I make has to be manually put in, but it's okay. I don't mind it. I love this stuff. I'm a geek for it, so I have no problems with it. But right now, with a total of about $7,800, okay, this portfolio is yielding me about $39 a month on average. Okay, so on a 12-month calendar year, I'm getting about $39 on average every single month. And you see my goal there is 50, and we're going to be there very, very, very soon. I'm going very, very aggressive this year with this portfolio. We're going to knock that 50 ball out of the park. But this app here, you can see over the course of the next 12 months, the dividends that I'm expected to get. And you can see here the projected yearly income. That is if I did not add anything else. Okay. If I did not continue buying stocks and adding to my dividend portfolio, you can see right here that the projected yearly income, this thing will continue to grow on its own over the years as years go on, right? But of course, we're not stopping right here. Can't stop, won't stop. And you can see the assets break down here as you go down. Now, here's one thing that I love. If you click on the events tab, it's actually broken down, and you can see what day you are due to receive a dividend. You can also see the ex-dividend dates. Everything is here, right here for you, again, on this calendar. Again, this is a free tool that I use to track my dividends and to keep me excited. It sort of makes it, puts it in sort of a game format, but it keeps me excited. It keeps me motivated. So again, hopefully you see something here. Again, you can use this tool if you need to. It is called the Dividend Tracker. You can get it through your app store. and download it. It is free. The only downside, again, is that you have to manually add your positions. But listen, other than that, that's going to be it for this one. This has been Play of the Day. I will see you all back here tomorrow in the next video where we go over the next stock and line item. All right. You all take care of yourselves, take care of each other. But remember, listen, whatever you do, invest diligently, but more importantly, invest responsibly. I'll see y'all next video. Later.